Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com gives us the latest on the major markets, including the mini meltdown in the Dow, bond action, and what's going on with gold. Reporting from Thailand, Martin Armstrong from Armstrong Economics gives us his view on what's happening in Asia, including the U.S.-China trade war and alleged currency manipulation. InsideTrackTrading.com President Hadk tells us how what's happening on the markets matches a 40-year business cycle he's been following. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Reaugh. We'll talk to Ross Clark right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Always good to be with you, Jim.
Ross, a rocky midweek for the Dow and stocks in general. What happened there?
Well, once again, it's a matter of headlines, and whether it was weeks ago and everybody was talking about the yuan or it's trade talks, and in this case, this was the week of the inverted yield curve. So, and what was it, 5-6 weeks ago? It was the oil market that was on everybody's mind. So the media just love to pick up on any piece of news, stretch it as much as they can in terms of what it generates in the way of headlines and anxieties. And the end result is you've got an S&P that had just a huge range this week, up and down a couple of times, but we're into the chattering phase. This is what we said would happen a week ago. We had that really good oversold on the 5th, bounced back 50%, and now we're just into this thrashing mode. So, if this news gets too bad one day, then it just seems to have an offsetting piece within the next 48 hours. And, the Thursday, Friday was exactly that, a little easing of tensions. But, you're in this mode this time of year when you want to be into stocks that have an underweight as far as the highly levered stocks, the high PE ratio stocks. You want to be into the more conservative groups that have got good solid dividends out there and decent but not extraordinary yields on them. So it's a market of one of individual stocks to be looking at more so than just the Dow and S&P.
Are bonds something you have to keep an eye on right now?
Well, I mean, this has been just the raging bull market to end all. You've got the long bond got down under 2% this week. So this is we're talking about a 30-year bond in the U.S. Government bond got a low of 1.92%. Managed to come back towards the end of the week. The 10-year got down to 1.48, and that then was lower by one tick as to what the 2-year rate was. That created headlines all over the marketplace. And, definitely overblown as far as the direction is concerned. You had one of the highest weekly RSI numbers that we've had in years, that being the relative strength index on the bonds, and on the notes, the same type of thing. So, as I say, headline item scares everybody in that they're talking now about recession as a distinct possibility within the next 6 to 18 months. Considering that we've been in a bull market here for 10 years without any really significant slowdown in the economy, a minor one in 2015, Yeah, we are due for a slowdown in the reasonably near future. The move in the yield curve typically, though, is a lead item. It does lead by as much as 6 months or more. So I think that as we've stated, as we move through the summer here, it's a time to be turning cautious. And as we get into the seasonally weak period in September, October, I think you really want to be in a very defensive position until we get a big clean out.
Our good friend Victor Adair pointed out gold is at an all-time high in 70 currencies, except the U.S. dollar, which it's traded in. But if you're holding it in anything else, it's done exceptionally well. What's your outlook for gold?
Well, clearly, this is you buy gold as an item of insurance against, and so it's for everyone other than Americans. It's doing exactly what they've needed. I mean, here we are, Canadian dollars at 75 cents round numbers. Last time that the gold was up around its highs in 2011, the Canadian dollar was at par. So, naturally, you've got gold trading through at all-time highs, and it's been a great investment for Canadians. I mean, I think what it's been for somebody in Turkey or Argentina, it's been just unbelievable, or Venezuela. Absolutely fabulous. So, what I see here is that you've gone through this consolidation phase that was under 1350 in terms of U.S. dollars, been under that for 5 years, had a good significant breakout. We've run from there up. We've put on roughly $200, $1,550, and it's very overextended right now. Sentiment is very, very much to the bullish side, more than 90% bulls. You've got the commitment of traders figures, which show commercials and speculators' positions at extremes. So the probability of a good hard correction within what should be the early stages of a bull market here are pretty good. If we start to lose some momentum and close down below the 1490-ish range, then I think it can gain some momentum as they start to run some stops because as you've had players come in, the speculative players come in a big way in this last few weeks, they don't have the deep pockets to ride out corrections. And the margin clerks are the ones who end up with control. If you end up being offside and can't put up the additional funds, they are in a position that they will just force you out of the market to raise that capital. And what we would like to see, whether it's right here or maybe it's from a high of around 1550, 1560, is a good hard correction. Something that would take us ideally, maybe down under 1400, a bit of a clean out. That would be very, very much like the beginning of the last bull market back in 2002, 2003. And if we look at what's happened with the mining stocks in this last few months, the miners were stronger than bullion up until the 25th of July. Since then, even though both have made marginally higher highs, the bullion has been outpacing the stocks. So the mining stocks are due for a correction along with bullion, and typically here you'd expect correction to maybe last as much as 2 months and be deep enough that if you've been in these trades for a while, you might want to lock in some profits and be looking to reestablish on a big hard correction.
Ross, thank you so much for chatting with us.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Martin Armstrong, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Martin Armstrong, founder of Armstrong Economics, available online at armstrongeconomics.com. He's speaking to us from Thailand. Martin, welcome back to This Week in Money.
Well, thank you for inviting me.
First off, what are you doing in Thailand?
Well, I guess all you have to look at is the news going on in Hong Kong right now. I mean, Asia is in complete turmoil. As you know, we have offices in China as well as down here in Singapore, etc. And we have clients on both sides of the controversy, and everybody's really, really going kind of crazy. They're very concerned that if China were to actually send in troops, what does that mean for Hong Kong and capital in Asia in general going forward? Can they trust accounts? I mean, it's really, really quite a major crisis.
A lot of people have pointed out Hong Kong, despite its small size compared to the Chinese economy and population, generates a huge proportion of their national income. Just how much does Hong Kong contribute annually to China?
It looked like China was doing really well in a lot of different areas, and this was people, effectively borrowing money in Hong Kong at a cheaper rate and bringing it back in and getting higher rates in China. So it made it look like there was a lot more going on than
If China does roll the troops in, would they leave, or do you think China would just permanently stay?
No, I think they probably would leave. China's not stupid in that sense, but the problem that emerges here is they're really in a crisis, kind of almost like the Roman Empire. When after Nero was killed, you had Judea rise up. They thought, okay, fine, this is the end of the Caesars, and they made their play to separate from Rome. And the general who became the next emperor, Vespasian, was forced to really go in there and really destroy the temple and everything else. Mainly because if he allows Judea to leave, then all the other provinces would say, hey, we'll do the same. So it's a question of what happens if China allows itself to lose faith with Hong Kong. Then domestically you have civil unrest that would rise up as well. So it's really kind of between a rock and a hard place here. They really can't back down. Otherwise they could create problems domestically. But on the other hand, if they go in, then they can cause problems financially throughout Asia, and the rest of the world. So it's really a very delicate situation going on over here right now, and keeps me very busy.
Would you expect China, if the troops went in, would it be a Tiananmen kind of massacre, or do you think it would be more riot police using relative reasonable force to calm things down?
No, they would use reasonable force. It wouldn't be brutality. They're not that stupid. So,
Martin, how was your May conference in Rome?
It was very enlightening, I think, for a lot of people, because we went over the real problems in Europe. And I think it was quite interesting. Nigel Farage came as our guest speaker there, and he called us the alternative to Davos. But effectively, people didn't even know that France, all these other countries, at least were allowed to vote to enter the euro. Germany was never allowed to even vote. Kohl, even, before he died, he said he acted like a dictator. He said he knew he would lose if he allowed the German people to vote. So he just pushed it through as a dictator. And he admitted that's what he did. So it's ironic that the German people never were allowed to vote to be in this mess to begin with. So you have internal problems within Germany that I know it doesn't really make the news so much in the United States, but there's even a separatist movement within Germany between North and South. We have a lot of people in Bavaria. I go down there, and it's very interesting. They say they're Bavarian first and German second. It's just a lot of problems, and this is part of the underlying support for the dollar, that people just don't get it. I know you got a lot of the people out there with the gold bugs, and they keep saying, oh, the dollar is going to go to zero and hyperinflation, all this stuff. It's very nice, but they won't even look outside the country. I mean, I'm over here in Asia. We've got a major crisis going. Then, you go over to Europe. I mean, you've got Europe going crazy, Britain trying to get out, which they really should get out, and people don't quite understand why they should, but then you have the U.S. Congress saying, trying to support the Brussels and saying that they'll block any trade deal with the UK. I mean, against Trump. This is what Pelosi came out and said. I mean, this is a complete disaster. It took even Obama years to negotiate TPIC, because why? Okay, you have 28 members, and every one of them has a right to vote on any trade deal. This is why trying to negotiate trade with Europe is a complete joke. I mean, it cannot be done. And what Brit exit is about, and in this customs union and stuff, they can't. If they did that, they might as well commit suicide. You're giving up all your sovereignty, and you can't negotiate with anybody. They don't understand what this is. Brit exit means that Britain can now negotiate with everybody else it wants to. And about 60% of its trade is with the rest of the world, not with the EU. So they can't do a deal with the United States because France can object. Anybody can object. Once they do, that's it. I mean, it's impossible. This is why people say, oh, Trump's starting a trade war. Honestly, he went in and he said, listen, I'll drop all tariffs. You do the same. The French immediately said, no way. So it is an impossibility. With all this trade negotiations, etc., it's really, really hard. And I'm not very optimistic about it. And then how you negotiate with China, it's a different issue. In the West, it's like, just show me the money. You make it rich enough for me, and I'll turn from Democrat to Republican or whatever. In Asia, it doesn't work that way. It's all about losing face. And you can't say, well, okay, fine, I'll give you an extra $100. It just doesn't work that way. If they lose face, then they lose, respect, and you can't negotiate that way.
We saw the Dow take a huge dive on Wednesday here in North America, and the S&P and other indexes also having major downturns. Is this a normal correction, or are we going to see a lot of this happening?
No, it's a normal correction process. We should be going down, and probably not so low anyhow. But most of the people, I mean, you turn on the TV and they're all talking about the inverted yield curve, and that confirms there's a recession, etc. Sorry, I mean, again, most of these people, they are purely domestic analysts. You have an inverted yield curve going on because you have capital flight to the Dow. And it's been, the bid on U.S. paper has been extraordinary. And just look outside the United States. We have crises over here in Asia. I mean, I'm dealing with major corporations that are asking me how much should they send over to the dollar. We have the same thing going on in Europe. I mean, this is closer to the Great Depression in the sense that 1931, you had all of Europe basically default. Britain went into a moratorium. I mean, France didn't. China defaulted. South America defaulted. It pushed the dollar up to record highs. That caused effectively our politicians who are actually dumber than a stone, but, this is all about trade, etc. So then they start protectionism, and they don't understand it's a capital flight. You've got all these countries defaulting on their national debt permanently. Don't you think money's going to fly to someplace? And so it pushed the dollar so far up to all-time record highs that Roosevelt says, oh, gee, we can't sell anything, so he then confiscates gold and devalues the dollar. I mean, here we are back again. You know, you have Trump listening to this nonsense again, and you have him saying, oh, well, China's a currency, manipulator. I hate to tell you, but they're not. They've been supporting the currency, and if they step back, the yuan's going to decline sharply.
We'll have more with Martin Armstrong when This Week in Money returns.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Martin Armstrong. Martin, is the U.S. dollar likely to remain the safe haven currency?
Yes, I don't see that changing, honestly, going into probably about 2021 to 2022 before at that stage in the game, I think the dollar is just going to push higher, and it's going to force some sort of a reset globally. I mean, I know, Trump has accused China of manipulating the currency, etc. I mean, he's completely wrong. China has been supporting its currency. It hasn't been suppressing it. And, if they go into Hong Kong, this crisis would be much, I would recommend step back. Go ahead. Show the world what will actually happen. And, if they go into Hong Kong, I mean, the yuan's going to decline. As simple as that. You're going to have a stronger dollar even more, and that's going to put tremendous pressure on Hong Kong, and we have the peg over there, which can end up breaking as well. I mean, we've got a serious crisis over here in Asia, which is why I'm over here right now.
President Trump has indicated he might meet with President Xi about the crisis in Hong Kong. Do you think that would help or hurt?
Look, honestly, we have a huge divergence here in analytical expertise. I mean, I was asked by one of the top 10 universities if I would, teach over there. I said, what? I was really surprised. I said, why are you asking me to teach? And I don't want to mention the name of the university, but they actually said to me that they knew what they were teaching was wrong. And they explained that, look, the problem is that people with real life experience that has been in the field, like myself, nobody wants to go back and teach. I said, no, you've been a hedge fund manager, a major player in banks, etc. You don't want to go back and teach some classroom with 30 kids in it. So that's the problem. They're still teaching things that, you take Keynesianism, etc. This is all based upon fixed exchange rate. This is why it all fails. And so you have all these people advising government, and like Larry Summers, etc. They're complete idiots as far as what really goes on out here. There is a film that the German film company is making a documentary on this, and I did a filming for it. They're getting some other people who have recently left the banks. And the biggest problem is that I'm independent. You have people with the same kind of qualification and experience, but they have been working for banks. And as a result, they sign confidentiality agreements. They cannot come out and say, yeah, the euro is going to crash, etc. The ECB will be on the phone in a second, and they will be fired. They can't talk. So it's very nice that we've pressed free speech everywhere, and I get emails from them all the time, and it's like, oh, it's really great. I wish I could say what you said. So the people that are at least going to appear in this film that they're making have just retired, so now they can come out and talk. But this is the problem. Anybody who works on a desk, as far as specs in Europe, they know the euro is going to crash. They've been, they've been like, this is in a joke. Now we say that. So it's the same thing. I mean, you get Trump over here calling China a currency manipulator. It's absolutely dead wrong. They don't understand what they're even talking about, and then they create trade wars over this stuff. So it's really a nightmare. It gets very, very frustrating from my perspective. You want to sit them down and say, you need somebody, to stop all this stuff in governments. I mean, you take this nonsense about lowering interest rates. We'll go negative. And you have the IMF coming out and say, okay, well, 10 years of it didn't work because it's no negative enough. And, okay, fine. Then you have economic growth collapsing. Well, the reason it doesn't work is because people are hoarding money. They took cash out of the bank so they didn't have to pay. So then what's their solution? Oh, well, we'll limit for cash. I mean, it's just, they won't even look at what they're doing. Fine, they're looking at lowering interest rates, and hopefully maybe somebody will borrow. What about all the retired people and pension funds? They have created a monumental disaster. Our calculations now show that there's a $400 trillion deficit in pensions globally. $400 trillion. I mean, there's no way we're going to be able to get out of this. I mean, it's all because of this complete insanity of lowering interest rates, going negative, and it's all based upon Keynesianism. And it just doesn't work. And instead of saying, okay, fine, maybe we've been wrong for 10 years, no, they want to go even further.
Is a commodity bull market likely to be good for the Canadian dollar?
Yes. We see that really coming after next year. We should, get a turn, but this is going to be more of a cost push type situation rather than demand. So it's going to be, a lot of it's going to be on the currency side because of the currency. But keep in mind, as the dollar is pushed up, that is really going to cause a lot of economic chaos. And you have to understand, the only time the world goes into a major financial crisis is when the dollar goes up, not down. U.S. always wants the dollar down because then they think they can sell more goods and they're happy. The dollar went up dramatically, as I said, in 1934. Roosevelt had to confiscate gold and devalue it, etc. The last time the dollar went up dramatically, the pound went to par, it was 1985. What did they do? They created G5. And, we're going to manipulate the dollar down 40%. I got called into that. I can tell you there were 35 of us that were called, and that's when I really got disgusted with government. At first I thought, wow, I guess I made it. I'm one of the 35 people, asked for my opinion. And then it was a dog and pony show. It was like, oh, okay, fine, Mr. Armstrong, how do we save the world? Oh, very sorry, your 10 minutes is up. Next. And then after these people testify, then they stand up and then they say what they intended to do to begin with. And we all look at it and it's got nothing to do with what anybody testified about. So I got angry and I wrote a letter to the White House. I said, this is absolute crazy. These people are going to end up creating a crash within 2 years, which was the 87. But, you just sold. A common person would figure this out. You just sold a third of the national debt to Japan. Now you stand up and you say you're going to lower the dollar by 40%, so you're going to lose 40% on everything in gold. Oh, you're not going to sell? Come on. They sold Rockefeller Center. They start selling out of everything. You just have idiots at the head of the helms of all these governments, and even the IMF.
Are you bullish on Canada?
Yeah, look, Canada will benefit because it's next to the United States. And it's not part of Europe, it's not part of Asia. All right, Canada has its own socialistic problems, and your taxes are way too high, etc. But aside from that, it's not in a major crisis situation as you see in Europe or in Asia.
Are gold and silver likely in the process of starting bull markets?
You're going to have one more correction out of this. Then you're going to be starting a real bull market. But, a lot of this has to do with, some people have been calling it the hype of changing the regulations with the ECB, and that that's going to expire on September 26th. So they're saying, the banks are going to be able to buy. They've been able to buy anytime they wanted. The agreement was to prevent them from selling. Okay, so it's completely opposite of what the spin that people have been putting on this. The selling pretty much died out after 2011. It dropped down dramatically. So there hasn't been a tremendous amount of selling coming out of Europe. The central banks have been buying gold in China and Russia. And that has been political from the standpoint of trying to reduce exposure to the dollar, and they also don't want the euro. So what do? So they've been buying gold to diversify to some degree on that side. Central banks can get away with it. I mean, that's fine. I mean, with the way things are today, I mean, you can't put, $100,000 worth of gold in a suitcase and hop on a plane and fly someplace. They will confiscate. I mean, so, gold's kind of lost its luster to some degree with the individual, that we're all restricted now on whatever you can take anywhere. But, I mean, you go to Italy and you wear a lot of gold jewelry and it looks like you got too much, they take it off and they weigh it.
Is the bond market acting as a safe haven?
Yes. I mean, that's why we have the inverted yield curve. It's not so much that, smart money was anticipating that we're having a recession, et cetera. We have a major recession globally, outside the United States. The U.S. is the only thing that's been holding up the world economy to any degree whatsoever. And, I mean, you just take Brit exit, for example. The German automakers are screaming because the politicians don't understand that the number one market for German cars in Europe is London. You're looking at manufacturing in Germany has been going down dramatically. We have a serious recession developing. Germany is particularly susceptible because they've been following the old mercantile model. In other words, they really didn't develop their domestic economy or consumer economy. It was all about, let's build this up until we can sell it to somebody else. I mean, that's what was behind the entire Europe. Germany, as I said, Kohl just put it through as a dictator because his view was the euro would eliminate foreign exchange fluctuations within Europe, and therefore the Germans would be able to sell more cars, etc., to everybody else in Europe, which was true. That was to their advantage. It's not the advantage of everybody else. So, that's what's been going on. So the world economy, I mean, China is actually declining at this stage in the game. Even here right now in Thailand, the economy's off. It's off in Singapore. I mean, and now you have, like I said, the tension in Hong Kong. Things can only get worse. It's not going to get better.
We'll have more with Martin Armstrong when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Martin Armstrong. Martin, do you see interest rates going higher or lower for the rest of the year?
Well, U.S. rates and on the government side, you have to separate this between government and private. On the government side, rates are being pushed down because of capital inflows. The Fed cut rates because the Federal Reserve has known it's now realizes that it's the central bank of the world. And it made no sense domestically to lower rates when the stock market was knocking on heaven's door there. Inflation was still starting to pick up. Unemployment there was no domestic economic numbers that warranted a rate cut. And so then, basically the Fed has been lobbied by everybody and their brother. And it's to lower rates. And the Fed has done so reluctantly. But capital is moving over here quite dramatically. So, that's the real problem. And as that capital comes in, it's bidding for paper, that just lowers the rates even more, which is why we have an inverted yield curve.
Are banks constricting credit around the world?
Yes. I mean, you have the biggest problem with the banks is that they have not. I was against TARP, etc., because honestly, the way the Federal Reserve was originally structured, it was correct to stimulate the book corporate paper directly. And then the government for World War I said, no, you only should be buying government paper because we need to sell it. And they never put it back. So what happens now is that, yes, okay, fine, that, to supposedly stimulate, they end up buying, taking in government bonds from the banks. Then the banks, evidence that they did not lend, they then went to the Fed and said, oh, gee, well, we got all this money, but we don't want to lend it out. We want you to pay us on excess reserves. And then the Fed goes, oh, okay, fine. So you're buying into bonds to stimulate, but then the banks don't want to lend, and they put it back at the Fed. So where was the stimulation? It's like Dumb and Dumber is running everything. I don't know. It doesn't make any sense, these decisions that they make. So you don't see the collapse in interest rates in the private sector. Denmark has just come out with an actual negative mortgage rate. It sounds great on the surface, but what they're not really telling everybody is that there's all sorts of bank fees involved. So it sounds good that the interest rate is negative. You're going to get 0.5% back every year. It's kind of like the credit cards. You're paying 4%, but you have X percent back. So it's just really scheming things. But on the private side, they eliminated the usury laws back in 1980, so Volcker could raise interest rates to 17%. Again, never put it back. So now everybody's paying 15 to 25% on a credit card. When interest rates are supposed to be zero? So you have a real difference between public and private. So if you're asking me if public rates are going to decline, yes, the government can manipulate that. There's no way that the ECB is going to raise the rate, and all they can do is continue to buy all the paper because they got all the governments on life support at this point. On the private side, you have interest rates actually going to rise because as with every recession, banks are even more reluctant to lend. So it gets tighter and tighter and tighter that way.
Are people in Hong Kong more likely to flee to Southeast Asia or to places like Vancouver, Seattle, and San Francisco? It's probably 50-50. Right now, I can say that down in Thailand, probably the number one tourists really are Chinese. They're pretty much, everywhere around the world at this stage in the game. But this is, I would definitely say you're going to see some people trying to get to Vancouver, but, you also have a lot of people looking at, Southeast Asia here. Is China's President Xi a believer in democracy?
It really depends. To some degree, the China system, they don't actually have to stand for election is a little bit better maybe to some degree because they don't have to placate people. I mean, in a democracy, the theory is nice, but it requires term limits. I mean, just look at what goes on. You got, like Elizabeth Warren and Bernie, standing up and saying, give everybody everything free. Whether it's economically feasible or not, it's like, it's bribery. Vote for me and I'll make sure everything's free for you. That's the terrible side of democracy. Particularly when you have people here that advocate things that are economically not feasible. I mean, it's nice, take the health care. Why is Obamacare a complete disaster? Because, again, it was kind of the same thing with the banks. Well, we'll force the youth to have to buy insurance that they don't really need. We'll fine them if they don't. So now the insurance companies will get all this revenue that they don't have to pay claims on, and they can lower everybody else's claim. They didn't. They just pocketed it. I mean, my insurance, I had Blue Cross and Blue Shield. They called me up and they said, we have to cancel your policy. I said, what's wrong with my policy? They said, you have to have maternity leave. I said, well, I don't think I'm going to get covered. All right? And I'm not married. All right? So what's the issue? And they said, no, everybody has to have maternity leave. So I lost my Blue Cross. They gave me another policy. And then they sent me 2 cards, one for children. I called them on the phone. I said, I don't have young children. And they said, well, you're not paying anything more, but you have to have it by law. It's a complete joke. I go to the dentist. They say, are you still covered? I say, I don't know what I'm covered for anymore. I give them a card. They go, your children are covered, but you're not. I said, that's you. It's a complete joke.
Is the U.S. likely to end up crushing China's economy over the lack of restitution for intellectual property theft?
I mean, that is a cultural problem in China. It's in a lot of other countries too, Cambodia, etc. They just feel, hey, if they can get a hold of it, they'll take it. I mean, you have to understand this is the way business is done kind of over here, and you got to understand the way it is. You have to really be on your toes with it. I mean, we have, the largest artificial intelligence system and the only one really in the world that does the whole entire world financial market, which is ironically at the same time why we're granted access into China. We're one of the few people that have financial reports that are broadcast in China. Everybody can buy them, subscribe to them, because they know a computer's writing it, and there's, you don't have to worry about on paragraph 4, by the way, overthrow your government. So most other Western analysts are not allowed in China. We're one of the few that are.
Is collapsing China good for gold and silver?
I think gold and silver will be moving up, but you're talking about probably the highs coming in around 2024 to 2025. We still have to go through a lot of different movements back and forth at this stage in the game. One of the more concerning issues, you have gold rising, but you've got the gold-silver ratio rising, which is not indicative of a bull market. So you're probably going to pull back. You'll trap a lot of people again at the highs, and then they'll lose money, etc. And it's just the way it's going. All these markets have to test both sides at this stage in the game because people are going to have to change their thinking process, and I think that's in the process of developing now. I mean, I'm running around the world, and I'm finding it more and more of our institutional clients, they're fed up. They really are fed up. People are losing confidence in the system. They're not trusting the central banks anymore. There's more than 10 years of negative interest rates that fail to work. It's basically, we're getting called all the time anymore. It's just like, you guys know what the actually going on. It's pathetic, but we are losing the confidence in the system on a global scale. And that's a critical issue. Once that happens, then everything starts to move.
Is government corruption around the world in the spotlight?
Pretty much. I mean, but it's besides just the corruption, which is at different levels depending on where you go. It's really just complete incompetence. I just don't see any reality here. It's always the same scenarios, and it's like sticking your finger in a light socket, and you get zapped. And you say, well, I'm just going to keep it up, because one of these times I'll be right, and I won't get zapped. It's always the same theories. Lower interest rates during a recession. They never have come up with a single new theory yet. It's pathetic. But, I mean, there's a Bloomberg video clip we have on our site. You can look up Larry Summers. And he's interviewed there, and they said, well, you've admitted that there isn't one guy that has been able to forecast recession yet. And he goes, well, yeah, no, we can't really do that. So, yet they step up and they go, oh, well, we'll put in negative interest rates. They can't forecast anything. And yet they just try. Oh, well, maybe that will work. And it's, honestly, to me, it's kind of like the medical industry where they used to bleed people. And, well, you know, if they bled you too much, you didn't die because of that. You died because they didn't bleed you sooner. And this is what they're doing. It's, you would think, after 10 years of a complete failure in this quantitative easing, somebody would say, maybe it doesn't work. There isn't any.
Does the deep state exist throughout the world?
Well, I think that we're really kind of looking at major issues here. I mean, I think on a global scale, it's just, there is like a deep state, for example, in various different countries. I think in the United States, it's got to the point of really absurdity. And you know, I've written before, started my opinion with George Bush. Ever since then, the deep state has gotten the power, and they've taken it way down. And they didn't very well. You had all the various agencies out for blood. I mean, they were trying to get rid of him because he was taking away their power. So it's just, the deep state is definitely there. It's not going away, and they're fighting tooth and nail to keep, whatever power they have.
Are President Trump's tariffs a good tool to fight unfair trade deals?
Look, I think, honestly, it is a tool that he fights with, and if you look at least what he did with Europe, he said, fine, I'll drop all tariffs, you do the same, and they said no. His tools with China are different because you're dealing with a different mentality than you are with Europe. So, Europe is much more socialistic, extremely so. So they fight over, ideas of really protectionism is what is the main goal of Europe, is to keep everything else out. China realizes what the problem is with Germany. That why is the German economy kind of failed in many respects? It's because they were, like I said, they were a mercantile model, build things and sell it to somebody else rather than develop their own domestic economy. I mean, you can also look on our sites we've published. I mean, even Italians have more net worth than the Germans. Germans are like near the bottom. So they have really not expanded their consumer market. It's always sold to somebody else. U.S. is the biggest economy in the world because it is a huge consumer market. And that's what has kept the world economy up. China realizes that. So China has been turning inward to try and develop its own consumer market. And that's why I think China will surpass the United States, and it will become the number one world economy, but we're looking out around 2032.
If people in power put other countries ahead of their own for personal gain, is that treason?
Look, I would say so. I think the whole problem is career politician. Once you are a career politician, you're always on that side of the fence, and you lose touch with the people, which defeats the idea of democracy. We are in republics. We're not in a democracy. I know, like everybody says, oh, China's against democracy. We don't even have democracy. We are republics. And the difference is that, if you look at what a Greek democracy was, yes, only the men voted, but it was only the head of the household. He represented everybody in that household. The wife, the sons, the slaves, everybody. All right. He voted. Rome was a republic. Instead of the head of each household voting, one guy represented the entire town. So you lost that direct contact. So a republic is much more susceptible to corruption. A democracy is not, when each household, even the head of the household, votes. And that's really the substantial difference between a democracy and a republic. So when we have a republic, and as long as you have that type of a system, what happened to the Roman Republic? It collapsed, and because it goes into an oligarchy. If you're always there, then somebody can come up and say, listen, I need this, and I'll pay you that. I mean, people don't realize, why do Democrats always talk about taxing the rich? But the Democrats also come out with the loopholes. This is the way it is. I'm really against more of a republic. I think it should be more democratic. It should be term limits. I think the idea was you went to Congress. The term was 2 years, so it wasn't burdensome. It looked good on your resume. Yes, I donated my 2 years to the government. And they only met for 6 weeks of the year. So it wasn't really that burdensome. But once they started meeting all the time, and then they said, oh, gee, I'm missing my crops, I should be paid, then it became a job. And then once it did, then they're ripe for bribery. So, yes, I think that is treason. They can be bribed, and bribes are very, very common.
Which markets are you currently watching closely?
I would say it's more of the share markets and currencies. Like I said, the share market, we should be getting this correction in here. But it's going to be the currencies are going to be setting the real tone of the markets going out for the next couple of years.
Do you have any investing wisdom to leave us with?
Just realize that we are in the early stages right now preparing for a major shift. And that means you have to push the market in both directions. So you have, you have these extraordinary changes in trend that everybody all riled up. So you got the stock market going down, and then you're going to have people saying, oh, see, this is it, the correction. Finally, they've been calling for a correction since, 2009. They missed a whole rally. And now they're going to say, see, I was right. Okay? And so they're going to be, chomping at the bit, oh, inverted yield curve, stock market should go down dramatically. And they'll be calling for, at some point they'll be calling for at least a 20 and maybe 40% correction. The gold people are the same thing. They say, oh, here you go, dollar's going to crash, whatever. That's not going to happen. So we have to test the upper bounds of resistance in there, which is, and you're talking about just under the 1600 area, like 1570 area to 1590. That's fairly important resistance. And then you fall back and you retest the pool. This is, testing both sides of the markets on all of these things. And then after January next year is when the sentiment will begin to change. And that's the key. When people begin to change their idea, their confidence in government and the future, then the markets become much more different than we've seen up to this point.
How can people find out more about Armstrong Economics?
You can go to our website. I mean, we do have the average investor who's not necessarily a trader. I mean, you can go on to Socrates. It's like we provide the computer rights reports from whatever. There's over 1,000 markets covers globally in every corner of the world. So, I mean, that you can go on for like $15 a month if you're just want to know what the trends are. That's good for the average person who's not a punter, not looking to buy and sell back and forth. And, you can go up the chain of command there if you're interested in that sort of stuff. But, I mean, the main thing that we try to provide is just a global view, which is not biased. I mean, the reports are computer writes over 1,000 reports every day. There's no human interaction in it. It's the only artificial intelligence system in the world.
Martin, thank you so much for being on This Week in Money.
Well, thank you for inviting me.
My guess
I hope
is
things get a little bit calmer so I can return.
hopefully. My guest has been Martin Armstrong, founder of Armstrong Economics. You can find him online at armstrongeconomics.com. He was speaking to us from Thailand. Coming up, Eric Hadk, next on This Week in Money.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadk, CEO and president of InsideTrackTrading.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
Eric, Wednesday was a pretty bad day for the Dow, losing 800 points. As we speak on Thursday, it's up slightly, 31 or so. Is this a pattern that we can expect to see for the near future?
I certainly think you are going to see that type of sharp drop and then lick the wounds and trade sideways for a little bit, then another sharp drop. You could see that pattern continuing throughout the month and potentially into September. It's also indicative of a very news-driven type of market where, first a week or two ago you get one tariff-type news hits the market, then another, delay of tariffs helps the market, then all of a sudden the inverted yield curve just sends the market into a tailspin. It's all of those kind of, in a sense, they're one and done. The news item hits, the market reacts violently, and then it's got to kind of sit and wait for some new guidance, new direction. But it all factors into what I've described as my overall, a very broad stroke outlook for 2018 to 2022. And there are a lot of reasons and a lot of both technical and fundamental indicators factored into that. But the most general was what I described as far as a 40-year cycle in the market, and that there were certain things in the market that were reminding me of the late 70s, early 80s, exactly 40 years ago, and that I thought we would see somewhat of a repeat of that. And during that 4 to 5 year period, the market, for all intents and purposes, went sideways in a wide range, but it would rally for 3 to 5 months, get back up near its highs, maybe a little bit above previous highs, and then all of a sudden it would have a 2 or 3 month decline that would wipe out most of what had been gained. And then you'd see some bottoming action, and then eventually it would kind of do that same thing, rally back up towards the highs. Maybe it would peak a little below them, a little above them. That general type of action is what I have been saying that I thought we would see in 2018, 2019, and even into next year. And it's really pretty much what you have seen. But even a little more specific than that, I thought it was kind of interesting and uncanny. You and I talked about this back in September last year, October last year, when when there was this 2-year cycle that was projecting a sharp sell-off. But the intriguing thing to me at that time and ever since is that this 40-year cycle continued to influence the markets. And, they say that the history rhymes, it doesn't repeat, and I would stress that in all of these discussions. But when you looked at if you compared the Dow's action from the late 70s, early 80s to the Dow's action in 2018, 2019, and potentially on out from here, there were a lot of uncanny similarities. And in fact, let me just rattle off a few real quickly. In 78, the Dow set a 6 to 9 month bottom in February of that year, and then it rallied into the end of the third quarter, beginning of the fourth quarter, into September, October 78. In early October of 78, the equity markets reversed lower, and then they experienced a 15 to 20% drop that lasted through the end of the year. What did we do in 2018, 40 years later? The Dow did the exact same thing. It set a 6 to 9 month bottom in February. It rallied into September, October. In early October, it reversed lower, and then it dropped 15 to 20% into the end of the year. Move into 2019 and compare it to 1979. In 79, the first half of the year, the Dow rallied in 3 very distinct waves, peaked in April, and then sold off for a month. In 2019, the Dow did very similar thing, had 3 rallies, peaked in late April, sold off for a month. Then after that month-long sell-off in 79, the Dow rallied to new intra-year highs, and it retested the peak that it had set the previous year in September, October of 1978. Come to 2019, exactly 40 years later, the Dow does almost the same thing, rallies to new intra-year highs leading into the third quarter after a 1-month sell-off, just like it did in 79, and it retested the peak it set in September, October of 2018, just as the market did 40 years earlier. In 1979, that retest of the previous year's peak led to a sharp 1 to 2 month sell-off that was fairly similar to its preceding decline, the one that occurred in the fourth quarter of 1978. And in 2019, due not only to that, but to a myriad of other cycles, technicals, and even some fundamentals, I was looking for the same thing, a sharp 1 to 2 month sell-off from mid to late July into late August and possibly lasting into September, and it's exactly what we've seen happen. So already on about an 18-month period, even a little longer than that, the stock market has really rhymed with, mirrored what it did 1 40-year cycle ago. But as is always important to me, synergy is the thing that I really look for with this cycle analysis and with a lot of technical analysis. And one of the most synergistic time frames was this July through September of 2019, and I've described since early 2017 why I thought that one of the sharp corrections in the Dow would occur during July to September of 2019, and part of that was also based on a very consistent 4-year cycle that timed a growing intensity of sell-off, first during that same time period in 2007, then during the same time period in 2011, and then even more intensely in 2015 when you saw the Chinese market really lead a sharp decline in July, August of 2015, and that too was corroborating this outlook for a sharp decline in July, August of 2019, and there have been a lot of other, I detail several more of the factors and have detailed them long before this happened of why August 2019 should see a pretty sharp plunge in the markets, and then we start to get short-term technicals confirming that, and then all of a sudden the fundamentals kick in right in the middle of that with that inverted yield curve fear really triggering things to the next level yesterday.
Now, of course, when you have an 800-point drop, people, I think, get interested, and of course it makes your nightly newscasts where mostly they ignore what's happening on the markets. Does this cause its own little cycle where there's panic in the system?
Well, there are definitely cycles that govern that too. In fact, a little over a month ago I was talking about how the VIX was corroborating this outlook for a sharp drop, but also identifying where the next peak in the VIX, which, is often a volatility index, really spikes higher on these sharp sell-offs in the market. And so that helps kind of identify where the panic selling points in the market are most likely, at least from a cyclical basis. And I'm able to apply a lot of the same technical indicators to that index, and the same indicator that was triggered earlier this week and told me to look for the most bearish part of the sell-off on the VIX chart. It gave a bullish signal based on that indicator on Monday, Tuesday, and said we were ready to enter the dynamic second spike up in the VIX and drop in the stock market. So yes, there are definitely times where there are cycles governing the panic moves in the market.
We'll have more with Eric Hadk right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Eric Hadk. Eric, is gold the place to be when the markets are doing this radical movement up and down?
Gold is certainly one of the beneficiaries of these sharp moves in the stock market. It definitely takes on its safe haven status when the markets get too unstable and too uncertain for investors. So you frequently do see those pops in gold. One of the things that I'm watching is that August is the kind of the extreme of some monthly cycle highs that I had in gold, but even more so in the XAU, the gold silver index of mining shares. And my work was telling me to look for two significant peaks in 2019, the first being in late February, early March, and the second being in August, where that XAU index should probably set a multi-month peak. So that's kind of giving me some additional expectations over what could unfold in the next few weeks. But definitely gold has and continues to benefit from this uncertainty in the market. And really that's a continuation of what it saw late in the fourth quarter of last year, that the gold bottomed in August of last year, the XAU index bottomed in September, and it was the overall stock market sell-off of October through December that really kicked their gold and gold mining shares bull market into gear. And the interesting thing when you're looking at that inverse relationship is that gold has maintained a more bullish structure even as equity markets rallied back up to their highs. You know, if you're looking at a exact 180 correlation, you would think that gold would go back towards its lows when everything's copacetic in stocks, and they've gone back up to their highs. But but the action of the first 6 months of this year just reinforced that there are other factors impacting gold that continue to support it and continue to reinforce the outlook for a 2-year bull market here, of which we're only a year into it, and that stock market sell-offs are only one of the factors that benefit gold.
Eric, beyond gold, are other commodities going to be going up or down, or do they go down with a market that seems to be stepping down?
Well, I think that when that's the primary thing impacting them, they often do suffer when the stock market is declining. But it's more when not necessarily when you see a one-off like yesterday, and I'm not saying that's the only decline we're going to see, but one of those isolated incidents that happens over a 24-hour period, and then cooler heads prevail, and everyone steps back and says, "Okay, is this really impacting the economy over the next 6 months? Is it just a realignment that's rally since late December in stocks has exceeded what was really justified, and now it needs to get back to an equilibrium point?" So it's more when you have a prolonged sell-off in the market that starts to influence all of your commodities from that economic standpoint. But many commodities, it's always that supply-demand thing. We're talking about the demand side that could conceivably weaken because of a slowdown in the economy. But if there are supply disruptions, then all that slowdown issue goes out the window, because suddenly you've got more dollars clamoring for a lesser amount of that commodity. And my work has been telling me to look for a progressively increasing price in a lot of commodities in 2019, 2020. So I think I don't know what the exact factors are that are going to trigger that, whether it is supply disruption, whether it's renewed demand, whether it's the economy starting to kick back in and starting to get a little more inflationary fears. Could be any of the above. That's why I prefer technicals, is because they lead the market. They'll often be in place for the first third or first half of a move, and then all of a sudden fundamentals kick in and corroborate what price action has already been showing. So whatever those fundamentals are, I don't know, but the only time that I'd look for stocks to have a real negative impact on commodities is if it's more of a drug out affair, that has more of a wet blanket impact on commodities than a quick sharp correction like we've seen recently.
Is this new pattern of interest rate drops, was that predicted by the cycles, or is this something from outside the ordinary?
A little bit of both. I thought originally coming in this year, I was looking for bonds and notes to rally into mid-year and then start to roll over, and by the latter part of this year be selling off again, which would mean higher interest rates, or at least expectations for higher interest rates. Those futures markets are always anticipatory, not necessarily, you don't always get the realization of those expectations. But I was watching in late June, early July. Once I have cycles that I'm anticipating, then it's up to price action to really tell me whether this latest weekly cycle is going to be the final one, or whether there's more to come. And we saw a decent sell-off in first half of July, but bonds and notes could not turn their weekly trend down. I identified some weekly cycles that were telling me, okay, we have one more push up, but the way bonds rallied the last couple of weeks was far beyond what I was expecting. But from a cyclic perspective, which the cycles in and of themselves do not give you price extent or price targets, it's other factors and other indicators that need to be integrated into that analysis. But the cycles showed that the next peak in bonds should be in late August, early September, and that actually is a pattern that those markets have seen for the last 3 to 5 years, as well as some weekly and monthly cycles. So this does appear to be kind of a blow-off rally in bonds, and that spike low in interest rates. So it wouldn't surprise me to see things, the perception start to shift in September, October. And from a fundamental perspective, I've been waiting for us to get, in the U.S., get a little bit more into the true election campaign season, and I've contended that would be when you would see bigger movement in the trade war. And one of my hypotheses was that you would find the U.S. making concessions the farther along we get, because the president can go on TV 100 times and say that all these tariffs don't cost the consumer a cent, but the reality is, and everyone else knows it, that the consumer is the one paying for it, and that's starting to have an impact on the economic outlook. So his answer to that is, it's all because the Fed hasn't been dropping interest rates feverishly. And so you get that whole perception kind of mixing up in there. But I think that China is certainly a strategic adversary, and I think they know what the vulnerability is in these negotiations, and it's once we get closer to election season, because the current administration's whole re-election hopes are hung on the stock market's high, the economy's great, everyone's happy monetarily, and the longer that the trade war drags out, the more that starts to have a whittling away effect at consumer sentiment and confidence, and as we're seeing now, starting to scale back some of the overly bullish economic expectations that were in place 6 months ago. So to me, I think that you're seeing a combination there, and that perhaps what could time a peak in the bond market and a bottom in interest rates is some more concessions. We just got them yesterday too. All of a sudden the market plunges, and now all of a sudden we're going to delay the tariffs till December 15th so it doesn't affect consumers, who we've repeatedly said it doesn't affect anyway, so what's the point of delaying them if it doesn't affect the consumer? Kind of some circuitous logic there. But I think that you'll see more of a movement towards a compromise in the trade war, and that's going to have a kind of a snapback effect on the stock market, on the economic outlook, and start to have bonds and notes head back down as the perception of at least stable interest rates overtakes the current expectation that we've got a recession on the horizon.
Bitcoin, where does it play in all of this?
I don't know that it has a direct placement in what we've been talking about. I still contend that Bitcoin completed an initial 6+ month advance back in late June. It could retest those highs in the coming weeks or months, but I think that it's got a wide trading range in which it's probably going to stay for a while. And that trading range really was set over just a brief period of time, but it identifies support down around 8,500 and resistance up above 12,000. And so obviously, again, a wide trading range, but on the chart, that's, I think, where a new plateau is going to build for a while before Bitcoin is ready for what I expect to be another wave up, potentially starting before the end of this year.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim. It's my pleasure.
My guest has been Eric Hadk, CEO and President of InsideTrackTrading.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Martin Armstrong, Eric Hadk, and thank you for listening. If you have any questions for our guests or for the show, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Jim, it's a nice, beautiful day here, and it's a good time to be on the show.
Larry, a news release earlier this week from American Manganese. What was in it?
Well, we were talking about doing the second phase of the material that the scraps that we had gathered, which is nickel, cobalt, aluminum. We'd done the NMC, nickel, manganese, cobalt. We got excellent results from that. And we're working on the nickel, cobalt, aluminum battery chemistry right now. And that's a chemistry that Tesla's definitely involved in, and so, you know, maybe there's some scraps there from Tesla's operation, I couldn't say. But it's exciting. This is the last link before doing the final stage 5, where we hope to save a lot of expenses, or save directly on one of the reagents, that's for sure. So that's moving ahead, and I think that was well received. We've had, Jim, we've had a lot of meetings, and this is Thursday, by the way, August the 15th, and we've had a lot of meetings regarding our process with interested corporations from all over the world, and that's why I won't be available tomorrow. I'll be most of the day at Cometco and meetings that were set up by Shailesh Reddy, the CEO of the Mega Factory in New York, and his group, and so we look at that as a very important meeting to the company, and Shailesh will be attending, and that's excellent. Gives us a little more time to get to know him. So that's the agenda for tomorrow, and consequently, I won't be able to do a podcast. So here we are today, and I think probably on most people's minds is the fact that the Dow took a real hit yesterday, down 800 points. As a matter of fact, it was a loss right across all the boards: Standard & Poor's, NASDAQ, Toronto, Vancouver, and that's always scary, and today everything's kind of going sideways. You know, the Dow's been up a little and down a little. So what does that mean overall? Well, first off, it does mean that the predator traders are out in force trying to drive things down with market momentum going for them.
so you always have to be aware of that. If you noticed, yesterday we got low closed at the end of the day, and with 5 seconds to go, and this always happens. And but it doesn't mean anything in the long run. The long run is that we have patents, and those patents are most important. And as a matter of fact, I've been doing a lot of thinking about those patents. And looking back at metallurgy over the years, going back 100 years and more, and you look at, the treatment of copper and lead zinc and gold and all those other metals that are out there, and, there's been improvements, but very little dramatic changes from the old methods. And I look at our metallurgical process, in which we're protected with 2 patents and a third one coming. And I think, people won't even be able to improve on those patents unless it's us for a period of 20 years, because that's how long our protection lasts on this. So that puts us in an excellent spot. Why is that? It's because people are beginning to recognize now that, hey, we've been paying attention to batteries and EVs for the last several years, then paid very little attention to the what's going to happen to the batteries at their end of life. And we've seen various stopgap measures, proposed, like, reuse and all those things. But right now, they're getting burnt in smelters. That's where they usually end. The end of life ends forever. And you get back some cobalt and very little of anything else, or I think maybe a little nickel. The rest of it goes into slag, and that's not a solution. We think with cradle-to-grave solution that our technology allows will only get better. That there's going to be, we're going to continue to work on our process and try to adapt it to other technologies that are out there for other metals, critical metals. And I don't know if we could ever get involved in the rare earth space, but I think that's a potential possibility. But right now we're focused on getting this pilot plant done, having meetings, and that's, trying to get ourselves financed to build a commercial plant. Because there's a lot of scrap material in the world, and that's the low-hanging fruit. That's what we're going after. We don't have to dismantle the batteries or anything like that. We're not a company that has techniques to dismantle the entire battery and scrap that material. There's companies that do that, and we're only too happy to have them do that. Well, we focus on where the real money is, and that's in the cathodes. And eventually the anodes. And the anodes, is mostly graphite or graphene. And, I think that can be done. We patented for that. So, but if we go after scraps, we don't want to divert our attention on anything right now except to get that process completed and to start drawing up plans to build a plant. And I'm not sure what the size is. We said three tons, but I actually think the minimum size would be 5, or it could be up to 20, 30 tons a day. But that remains to be seen. There's a business plan for 3 tons on our site. And I just to remind you, that's just the numbers we worked with, what we have. And, it's certainly not a final feasibility that should be taken to the bank. So, but other than that, we're excited. I mean, yesterday was depressing for most people. And, but is the market going to crash? I don't have a crystal ball, so I can't really say whether it will or not, but I don't think it will. I think that we're going to go on have our ups and downs as usual in the market over the next few years. And eventually, yes, the market will crash. And, at that time, I'm thinking that we may be an established commercial enterprise. So that's the way I see everything. And I wish everybody a very great weekend coming up. And I think that I had some other things I was going to talk about, but I'll save that for another time. Thanks, Jim.
Larry, where are you traded, and how can people get more information about American Manganese?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. And we're traded on the Frankfurt Exchange under the symbol 2AM. You can phone the company at 778-574-4444, or you can visit our website, www.americanmanganese.com, or you can email me at LREAUGH@AMYMN.com.
Larry, thanks a lot for the update.
You're welcome.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on August 15th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.